If I had to start investing in 2025, here's exactly what I would do. A lot of people overcomplicate investing or think you need a ton of money to start. But the truth is, the best time to start is now, no matter how much you have. And with so much noise in the market, it's very important to do things the right way, not just follow the hype. So let's break it down step by step. Step 1. Build a strong financial foundation first, before even thinking about investing. The first thing that I would do is get my financial house in order. Think about it this way. If you're paying 20% interest on a credit card, that's like setting your money on fire every month. No investment is going to consistently give you a return higher than that. So paying off your debt is a guaranteed win. That means paying off high interest debt, especially credit cards. For example, if you have a $5,000 balance at a 20% interest rate and only make minimum payments, you could end up paying more than $10,000 over time. Instead, prioritize knocking that out as fast as possible. Having an emergency fund of 3 to 6 months worth of expenses. Life happens, whether it's job loss, medical bills, or unexpected car repairs. Without an emergency fund, you might be forced to sell investments at a bad time. A good rule of thumb: keeping your emergency savings in a high-yield savings account so it earns some interest while still being easily accessible. I would get my cash flow in check. Before investing, I would take a hard look at my budget and figure out how much I could comfortably invest every month without feeling stressed. For example, if I make $5,000 a month and my expenses are, say, $3,500, then I could set aside $500 to $1,000 per month for investing, depending on my goals. Once these basics are covered, I can start investing with confidence. Step number 2, invest in a diversified portfolio, and I'd start with index funds. A lot of new investors think they need to pick individual stocks to get rich. But the truth is, even the best investors struggle to beat the market consistently. That's why I'd keep it simple and invest in low-cost index funds, like the S&P 500 ETF, VOO or SPY. Think of it like this. Buying an index fund is like buying a piece of the entire US economy. Instead of betting everything on one company, which could fail, I'd be betting on the long-term growth of 500 of the biggest companies in the country. Historically, this has returned about 8 to 10% per year over the long run, which means doubling your money every 7 to 10 years. To put this into perspective, if I invest $500 a month in an S&P 500 fund for 20 years, assuming a 9% return, I'd have over $300,000. And that's with just consistency, no stock picking needed. Step 3, diversify internationally and across asset classes. To take diversification even further, I wouldn't just invest in US stocks. I'd also add international stocks like VXUS or VEU, and different asset classes like bonds, BND, real estate, VNQ, and inflation-protected securities, TIPS. Why? Because economies rise and fall. The US market won't always be the best performer. In fact, there were decades where international stocks outperformed the US. Plus, real estate and bonds help smooth the ride when stocks take a hit. For example, if in 2022 you had a portfolio consisting of just US stocks, you'd be down almost 20%. But if you had diversified in international stocks and bonds, your losses would have been much smaller. Diversification helps you sleep better at night. Step number 4, I would use dollar cost averaging and automate my investments. Trying to time the market is a losing game. Instead of dumping all my money in at once, I'd use dollar cost averaging, which means investing a set amount at regular intervals. For example, every 2 weeks or every month. Let's say I have $10,000 to invest. Instead of dumping it all in today, hoping the market goes up, I could invest $1,000 per month for the next 10 months. This way, if prices drop, I get to buy stocks at a discount. And if prices rise, I still benefit from being in the market. To make this even easier, I'd set up automatic investments, so I don't even have to think about it. The key is consistency, investing regularly no matter what the market is doing. Step number 5, be tax smart about where I invest and maximize employer matching. A lot of people focus on what to invest in, but they forget about where they invest. Taxes can eat up a huge chunk of your returns, so I'd make use of tax advantageous accounts. The first example is retirement accounts. Many countries offer tax benefits for retirement savings, such as tax-deferred or tax-free growth. I'd contribute as much as possible to these accounts to maximize long-term gains. The second is tax-efficient or tax-free investment accounts. If available, I'd invest in accounts that allow tax-free withdrawals or tax-efficient investing to minimize the amount lost to taxes over time. Most importantly, if my employer offers a retirement savings match, I'd make sure to contribute enough to get the full match. This is free money that I don't want to leave on the table. For example, if my employer matches 50% of my contributions up to 5% of my salary and I make $60,000 a year, that's an extra $1,500 per year just for investing in my future. Over 20 years, with a 9% return, that could grow to over $80,000 just from employer contributions alone. By using the right accounts and taking advantage of employer matching, I could keep more of my profits and maximize my investment growth. Step number 6, stay invested and avoid emotional decisions. The biggest mistake new investors make is panic selling when the market dips. But here's the reality. Market downturns are normal, and the market has always recovered over time. For example, if you invested $10,000 in the S&P 500 in 2008 during the financial crisis, your money would have more than tripled by now, despite the market crashing over 50% that year. That's why I'd make sure not to check my investments too often. The more frequently you look at your portfolio, the more likely you are to make emotional decisions. Instead, I'd set it and forget it, letting my investments grow over years, not days. Investing in 2025 is one of the best ways to make your money work for you and build real wealth. If you found this helpful, don't forget to like, subscribe, and hit the bell icon so you don't miss any of our future investing and money tips. Thank you for watching, and as always, stay money-minded.